Welcome back, ladies and gentlemen, to a new ICT 2024 Mentorship Student Review of the live stream ICT made on the September 17th. The topic which was discussed in his live stream, is how to manage missed entries. You can find the live stream and the link of the live stream from ICT in the video description below, and also the link to his YouTube channel. I would closely advise you to read through the risk disclaimer, because this is for educational purposes only, and I'm not trying to teach you any new ICT concepts or try to sell your course and repackage his concepts. I'm just giving a student perspective of the key takeaways from yesterday's live stream. You can see I used ICT's charts in my presentation. I also have the link to the ICT mentorship, the live stream right here as my source. So I hope this is okay, because I have no access to the 15-second chart. I hope this will be fine. So ICT started the live stream by outlining the 5-minute sell-side liquidity pool with the new week opening gap below it right here on the 15-minute chart, over here the relative equal lows on the 5-minute chart. And the market started the session with a premium gap. A premium gap means 9:30 opens higher than yesterday's settlement price, so we gap higher, which creates a premium gap. And ICT tells us that there's a 70% chance that it trades back to the mid gap. So I will show you this on the next slide. Also, he outlines the first presentation fair value gap. This is the first fair value gap that forms after 9:30 a.m. on the 1-minute chart. The ICT live stream focuses ICT primarily works with the 1-minute and 15-second chart in his live stream. He tried to work within the 10 a.m. hour with the silver bullet model, and he wanted to wait for the 9:50 to 10 a.m. macro. So let's jump into the next slide, where we have the opening range gap. ICT divides this into the 4 quadrants. He does this here on the 1-minute chart in the bottom left corner, pulls this from yesterday's settlement price to 9:30 a.m. opening price. And he divides that into the quadrants. And you can see this is the middle, 50%, so this is the mid gap level. And ICT advises that because tomorrow, or at the time of this recording, it's already today, Wednesday, in the evening, we have the FOMC news release. And you want to trade the AM session if you have, so when FOMC is on Wednesday, you want to trade the AM session on Tuesday, and not the PM session on Tuesday or the AM session on Wednesday, because they tend to be very, very spotty in price action. Due to the lack of experience, of course, it is advised to stay away completely from the FOMC days, because it's very, very manipulative. Usually it's like NFP and CPI, where we have a 2-stage delivery, and at 2 p.m. we will trade in one direction, so the first news release, and then at the press conference, 2:30 p.m. we will create a counter run. Usually, not always, but this is the whole process of this 2-stage delivery, so we kind of get a reversal of the initial move. And ICT makes a distinction between the opening range and the opening range gap. So these are 2 different things. The opening range gap is just the gap from yesterday's settlement price and 9:30 a.m. opening price, so regular trading hours, the gap which we form. And the opening range simply is the 30-minute time interval from 9:30 to 10 a.m. So if you use these terms, keep them in mind and use them the right way. Keep your expectations minimal the day before FOMC, and don't try to swing for the fences. The market traded into the first presentation fair value gap, again the 1-minute fair value gap that forms on after 9:30 a.m. the first one, marked out in red right here. And the market swept If we look at the 15-second chart, the market swept the swing low right here and traded into the lower quadrant of the opening range gap, created a fair value gap, and traded higher from there into the first presentation of the fair value gap. ICT then went quickly into HFT stands for high frequency trading with fair value gaps without a bias. So you can use this concept where the market trades to the mid gap of the opening range gap as your bias in the first 30 minutes, but we will go into that in a second because he outlines a complete model for this trading procedure. He doesn't go really deeply into the high frequency trading, but he says you should look for 5-minute or 1-minute relative equal highs or lows if you want to trade high frequency trading with fair value gaps without a bias. And the market delivers the run on the sell side liquidity from the first presentation fair value gap. You can see we trade into the new week opening gap as well. Then I don't know why ICT also didn't go further in depth on that, but after we ran sell side liquidity, he focused on the 50% of this wick right here, and we were watching still the mid gap delivery, which is this gray line right here before 10 a.m. And finally, market drops into the mid gap and we have that delivery. The next downside objective was then the lower quadrant, which is this blue line. In the days before FOMC, the market can color outside the lines. As you can see here with the first presentation of the fair value gap, we trade slightly above it, but this is okay. And on days like these, ICT advises you to watch how it trades to the fair value gap, and then you should be rather more selective and not just placing a limit order right here and taking the lowest entry, but let it run to extremes on days like these. You will also get a much better fill because of the premium price. So the first 30-minute bias with a 70% chance is the return to the mid gap. There's a rule for that. The opening range gap should be over 40 handles. In this case, we had more than 40 handles. You can go back to the charts and measure it yourself. Then pick the first fair value gap that forms between 9:30 and 10 a.m. If the fair value gap is below the mid gap, then we're bullish and we're looking for longs. This is then our bias. Or in this case, we had the fair value gap above the mid gap level, which is this one right here where the cursor is. Here's the fair value gap and it's above, so we're bearish and we're trying to short it down there. So our bias is bearish in the first 30 minutes. And this could be your model. Stop loss would go above the second candle's high, and we anticipate the market to color outside the lines again, as said already, on days before FOMC and CPI and NFP, all these major news events. Same rule, you can apply this model to ES. YM is more spotty and you will have more adversities because it usually tends to wick around. And ICT mentions that we're in the December contract month. Also, we have seen a divergence between ES and NASDAQ. If you would look at the candlesticks wicks, then you would see no divergence. You can see NASDAQ also made a higher high. But if you look at the bodies of the candles, you can see ES made a lower low and NASDAQ a higher high. So this is real divergence, and that's how you can spot it. Usually, going back to the topic, when you miss a move, you have two choices. You get angry and emotional, so you chase or fade the move. In both cases, this is a very bad decision for your psychology and also for your account balance, probably. ICT mentions the 926 level for NQ. This level is derived from the NQ EU 2024 contract, September contract, where we have relative equal highs on the 1 hour chart. And if we don't go there today, this was his statement, then FOMC will probably target that area, but this is only a vague expectation by him that could change if we come closer to the time before the news release. You can find very high frequency trading setups, but you will get stopped out a lot because you're chasing every potential run into liquidity. That, again, referring to him to the high frequency trading models, which he doesn't really go into quite, but he refers to this also as a high frequency trading model. So a short from here to the mid gap would be also a high frequency trade for him. So time where you will mess up are when you don't refer to the time of day, day of week, week of month, and seasonal tendency, or where the higher time frame order flow is reaching for. It's more reasonable to leave the level he mentioned upstairs for FOMC because it's really clean and relative equal highs on the 1 hour chart. So the model presented in the ICT live stream, we will do further back testing and extensive research on this channel in the coming videos to this model. We will back test and post the results right there. But first of all, the opening range gap model. The opening range gap must be over 40 handles, the more the better. And the idea is that you have a 70% chance that the market will trade back to the mid gap before 10 a.m. You should wait for the first presentation, fair value gap. If it's below the mid gap, you're bullish and you try to go long from the fair value gap, of course. And if the fair value gap is above the mid gap, like today, you're bearish and your bias is bearish and you're looking to short at the fair value gap, at a CB. Stop loss is placed on the second candle of the fair value gap. So usually a fair value gap consists out of 3 candles. You place it above the or below. If we look at CBs or BISIs, it must go above or below the second candle. And when it breaks a short-term low or high, you put your SL to cover costs, meaning you put your stop loss to break even. And if you decide to hold for the full close of the opening range gap, then take 80% off at mid gap, take partials and let the rest for a runner. If the opening range gap is above 200 handles, avoid the setup because we could just continue higher and not offer a retracement back to mid gap. Focus first on 1 setup per week to build confidence and discipline, and also start with 1 contract only, micros. So this is basically the model. You have the opening range gap right here. You have the mid gap line right here. And we open and form the first fair value gap, first presentation fair value gap above the mid gap price. So our bias is short in until 10 a.m. for the first 30 minutes after the market opens. And so we're looking to go short at this CB right here. Stop loss goes above the second candle of the fair value gap, and we're aiming for the mid gap. If you want to leave a runner, then close 80% right here and let the rest run. After we break the swing low, you should put your stop loss to break even to cover costs. And this is basically the model. Simple, easy, and rigid rules. Again, the opening range gap must be at least 40 handles. The more the better, but not above 200 because then the market will likely tend to trend in one direction. ICT also goes over the premium pricing concept. In a carrying charge market, the prices in the future will usually be more expensive. He gives the example between the December contract and September contract of NQ. The NQ contract, December contract, is listed at 19,800, and the NQ September contract is listed at 19,561. So you can see December contract has a premium price built in. Again, that's what I wrote here. And this concept is more useful in the real and supply-demand market, like consumable goods, oil, corn, and lean hogs, and etc. If you're bullish, you want to see the nearby contract have a premium. If this concept inverses, so the future contract has a lower price, then you have a commercial bull market If you want to go further into this concept, then watch the ICT 2017 mentorship in month 10 under the folder commodity trading. You'll find this on ICT's YouTube channel. I will link it also in the description below this video if you're interested in that. But then the live stream went on and the lows have been made jagged and we have clean relative equal highs. The 15-second chart is spotty, as you can see. That's because we have FOMC tomorrow on this day, and you have this buy side liquidity right up here. And next on, we sweep the buy side liquidity, trade into the new week opening gap right here. ICT wanted to see this 15-second fair value gap to stay open because we already dropped into it once, but if we would trade higher from here, but that doesn't happen and we close this fair value gap in. ICT was also looking for a long from this 15-second fair value gap, and he was also looking for an inversion of the CB from the orange box. He mentions also the consolidation on the 1-minute chart right here to the left of the chart and how much time it spent there. ICT refers to the breaker. You can see we have a low, a high, a lower low, and then market breaks this high. So this is our breaker, and we have also the daily high of September 13th, so as a confluence. And if we would have lost this level, we might enter into a lunch macro. So once we trade below the breaker, below the low outside of this blue area, we would enter the lunch macro where we would trade against the traders that had positioned themselves long and profited from the initial move higher. But first it had to leave the breaker. ICT isn't convinced that we would take out this intraday low. He wanted to give the market one more chance to sweep the sell side liquidity right here, and he was looking for a 20 handle move for the market to give it to him. And as long as we stay below the 50% of this breaker, you can see we traded through it, and then the market ran this intraday low, and we're retracing higher back into it. And as long as we stay 50% below the 50% line, this orange line of the reclaimed breaker, ICT isn't interested in any longs. So it may even set the stage to run below this low again right here. This run higher for ICT was too shallow. He wanted to see deeper retracement before looking for a short. And you can see the market is slowly ticking higher like this, and ICT refers to this that the market is entering a buy program. Nothing can stop price from moving higher. So our algorithm is entering a buy program and just pushing price higher. So if you were in the short, you would be in a pretty bad place watching this. If you look at the 1-minute chart, you can see we have no fair value gaps. Everything seems balanced in price, and it's slowly booking higher prices. ICT then mentions this 1-minute inversion fair value gap. You can see market traded above it, so it becomes an inversion fair value gap. Now he wants to see that the market treats this as support. If we trade higher, he wants to see retracement back into it to trade higher into this open 15-second CB right here. Market didn't do that. You can see it also didn't close above the inversion level, so it failed to trade higher, dropped lower. And ICT was now watching the lower CB right here, coupled with this volume imbalance, and he wanted to see it stay open. Preferably, it also would have stayed inside this orange shaded area, but it traded outside of it, as you will see, because this would be a balanced price range. You can see right here. So coupled with this BISI and CB right here, this would be a balanced price range. So if we would drop below it, trade to the 50% of it, consequent encroachment, he would look for a short from the constant encroachment of this BPR right here. And the drawn liquidity is now on the sell side, the lunch macro draw. Again, market retraced higher as he expected, and ICT is now looking to short the NQ from here. The idea is based on the inversion balanced price range and the CB on the 15-second chart. Stop loss would be above the 50% of the first week's candle. Right here, you will see that on the next slide. You can see he's pressing sell, the sell button, but paper trading of TradingView wasn't working, so you will see no execution. You can see the stop loss is at the 50% of this candle right here from the fair value gap, the first candle right here, 50% of this week is his stop loss. Entry coupled with the inversion level and the CB right here. So once we break this swing low, stop loss should be set to cover costs, meaning you should go break even. Stop loss would be trimmed to the fair value gap low once we created also equal lows, took them out, and then ICT was saying that we should trim the stop loss to the fair value gap right here. So market traded higher, stop loss on balance, take profit was here at the sell side liquidity. The key takeaway, it's not about perfection. If the market would have left the CB open right here, if we wouldn't trade to the volume imbalance and close in the CB, then the market would run lower and be more sudden and quicker in the delivery of price action. And now we had this back and forth, which was not nice. But yeah, I hope you enjoyed the presentation, and I will see you in the next review. Leave a like and subscribe. If you found value, you will find the study notes of all the slides in the video description, so you can go back and review them. I wish you a pleasant day. Until next time. Bye.